The stock market is extremely bearish and looks like it's about to fall off a cliff. Considering we've got more rate hikes coming this year, we could be seeing blood on the streets.
Sell down in April at 142!
I'm Biko Konstantinos, and that's what we're going to talk about today. If you like animals, like Barry, give this video a like. And why don't you consider subscribing to my channel? You might actually like my content. Now let's see what's happening with the stock market and what it means for the global economy. The Dow Jones, the top 30 biggest companies in the US, is right on the edge of a cliff and might be about to fall over. The current price here is sitting at the pre-COVID levels, which is a very significant psychological level in the stock market. We can see when the market was trying to break this pre-COVID level going up, there was a gap up and then it didn't look back and it kept powering on. Trouble is, now we're going the opposite way and the same thing could happen. So when this level genuinely breaks out, there could actually be an acceleration of downward movement, because basically it would mean that all these gains here have been wiped out and all the greed and euphoria that was in the markets during this massive run up could turn into fear and panic on the way down. So what's causing this extreme bearishness in the markets? Well, the Fed has just raised interest rates by another 0.75%, which is the third oversized interest rate hike in just 3 months. Now, the biggest concern seems to be around the speed of these interest rate hikes. Just last year, the Fed was ultra loose with its monetary policy, keeping interest rates almost zero, saying that inflation was transitory, and pumping trillions of dollars into the economy. But boy, have times changed. Although the latest interest rate hike was expected, it seems to be the wording that's starting to spook the markets. The central bank has signaled more raises to come, lifting rates by at least another % by the end of this year, and not predicting any reductions until 2024. So that's indicating higher rates for longer. We have got to get inflation behind us, said Fed Chairman Jerome Powell. Trying to achieve a soft economic landing will be very challenging, he said, and no one knows whether this process will lead to recession or how significant that recession would be. So the Fed has signaled they're committed to reducing inflation, and because of that commitment, the market is getting scared. Higher interest rates normally lead to higher unemployment, which then leads to declining economic growth or a recession. And a recession normally leads to a loss of wealth or a loss in living standards to the general population. It's important to understand the psychological phases of the stock market. The market's just made up of people, so the emotions of all those people combined gets amplified because we're dealing with large groups. Here we can see a boom-bust type scenario where during the boom phase, there's enthusiasm, there's greed, and it keeps getting pushed up, and delusion. In my opinion, that happened in 2021 with the massive rise of crypto, meme stocks, NFTs, stock market, housing, and pretty much anything else. When the Fed floods the economy with money, that money has to go somewhere, and when everyone sees incredible gain, it just feeds on itself and goes higher and higher until finally there's no one left to buy. And that happens around here. Then the first falls start to occur, but because we're so used to seeing never-ending price rises, the old mantra of buy the dip continues, and it starts to look like it's actually working as markets rise a bit, but then the inevitable fall. After the major top, there's normally a period of fear with some optimism and some fear and optimism, etc. And that's this period here. Now, if the market keeps falling, a lot of that optimism dries up and the market gets more heavily weighted towards fear, and then what can happen is capitulation. What is capitulation? According to Investopedia, capitulation typically follows significant downturns in price, but this is the critical item. As the downturn accelerates, it reaches a point where the selling by investors unwilling to suffer further losses snowballs, leading to a dramatic fall in price. It's like when the pain just gets too much. Just say you had a stock and near the peak it was trading at about $2, and then that stock drops to $150 and then $120, and in your mind you might be thinking, well, it's a volatile stock, it's a bear market, I can afford to cover those losses and it's going to come back again. But what happens? That stock keeps falling and it falls below $1, so you've now lost more than 50%. And alarm bells start ringing and investors might start to feel, I cannot afford to lose any more on this position or positions. And then they sell out at the same time a lot of other people are selling out, which leads to those dramatic falls or plunging in the stock prices. The Nasdaq provides a great example. Straight after COVID, the Nasdaq's pretty much gone straight up. And the psychology during this boom period definitely was enthusiasm, greed, and even delusion, where market participants think that it can keep going at that same rate forever. But once it started to fall, we saw some fear and caution enter the market, mixed with some optimism, then some more fear mixed with some optimism. But so far, in my opinion, we've yet to see capitulation. But if the Nasdaq falls below this level here, selling pressure could easily accelerate, and if declines continue, we could definitely see capitulation around this area here. The Russell 2000 small cap index looks even closer to a major breakdown. The current price around 1700 is sitting at this major support level that's now been hit once, twice, and 3 times. And this makes sense because those smaller stocks didn't gain as much as those large stocks during the boom, such as Apple, Amazon, Tesla, and stocks like those. So they've fallen back to pre-COVID levels quicker. But if this index keeps falling from here, we'll be at the same level during these panic stages during COVID. And that would indicate to me that the economy is in trouble. One of the most worrying things about all this is the fact that the US and other countries around the world pumped massive amounts of money into their economies, raising their national debt levels to extremely high positions. Here we can see in the US after this COVID period, the national debt soared to over $30 trillion. So now we have countries with extreme levels of national debt, a stock market that's very bearish and falling, and interest rates being raised aggressively, meaning the payments on that national debt is increasing exponentially. So yes, all that money had an effect because it created the everything bubble, but if all that bubble gets wiped out, you're still left with the debt payments. The fund's a distant memory, but you're gonna feel pain for the next 12 months. Another reason I don't think we've seen real capitulation in the stock market is due to the VIX index. The VIX index measures volatility in the stock market. At the early stages of COVID, the VIX index soared. And that was the crazy period where everyone was selling because they didn't know what was gonna happen. But since then, the VIX has traded in a bit of a range. Now, if the entire stock market did start to capitulate and plunge, I'd expect to see this VIX index or volatility start to jump. Now, I don't think it would reach the highs of this COVID peak because that was something that came out of the blue and shocked the entire globe, but greater volatility in the markets would show up in the VIX index. So we've got a stock market that's at major risk of a breakdown. But what does all that mean? There's been many bear markets before, so is this any different? And I would say yes. And that's because we could be seeing an everything crash just like we saw an everything bubble. And if everything does crash at the same time, there could be huge economic effects. We've already seen the speculative market crash like crypto. We could now be witnessing a stock market crash, and we look to be at the early stages of a real estate crash. See, at the moment, people are still mostly feeling quite wealthy because the price of their property has soared over the past couple of years. And when people feel wealthy, they're okay to spend. They don't feel too fearful because they know in the back of their mind what their property's worth. But if property prices start to really fall, for example, if the past couple of years' growth suddenly disappears, that's going to have disastrous consequences for the entire economy, in my opinion. So we could see the perfect storm for the global economy. Stock markets crashing, real estate crashing, and central banks unable to reduce interest rates due to high inflation. In other words, they could be powerless to stop the crash. Will this happen? I don't know, but it's definitely a possibility we should be aware of. I'm Biko Konstantinos.